So Rich, we're back, and we want to show people now how we can use the random market data that we've generated to test EAs and to prove to ourselves and maybe to them that there is a bias in the market, and it's that bias that we capture with our EAs. So we've shown people how to create this random data, but we might just quickly go through that again.
All right. Actually, should we start with showing them what our systems are?
Can do that too, yeah.
Show what our systems are and how they apply to an example of a real market data. Then we'll go to the random market data we've created and the biased series we've created.
Yeah, okay, that makes sense.
All right. So for this particular exercise, we're using the currency pair AUD/USD, or the Aussie dollar. And so we are applying a simple breakout trend following system to this particular market data series. So Fred, can you just describe this particular multiple systems that we're trading?
Yeah, people would have seen this before. We've shown this a few times. What this is a CSV file that is dragged in by the expert advisor to place trades, and it places trades in a breakout fashion. And you can see here we've got 17 EAs in this grouping, and they're all based on a Donchian breakout. So we've got a Donchian period that averages, or moves, from 200 through to 1,000 in steps of 50, purely random. ATR period, constant, we're not changing that. And just to demonstrate, there are some differences with different stop loss and trailing stop configurations. We've got a random array there. So they're not random, they're in a sequence, but they're here to demonstrate. So what happens now is when we run an EA that makes use of that data, it uses those parameter sets to trade. So what Rich is going to show you now is that EA, that trader, on the Aussie dollar running from 2,000 through to a couple of days ago.
Okay, that's all ready to go, Fred. So I'll put it on visual mode here, and we can speed it up after we see how it's working. So we're ready to apply it.
Yep.
So here we go. We've started the trade sequence, and you can start seeing trades starting to be initialized. In this case, in the short direction, you can see the trailing stops as they're hugging price as they're moving down the short direction. And over here we can see our equity curve slowly build when we have a favourable move, and we can see it stagnate or decline when we have unfavourable market conditions. So I'm now on this real market data, just going to speed things up a bit, but this is applying our system to real market data, which you're all very familiar with, as we've had many of these particular demonstrations in the past in our video series.
Yeah, so what this is demonstrating is that this EA, which is basically a series of Donchian breakouts on the Aussie dollar, produces a number of trades and an equity curve, as you can see, being painted as we go.
That's great, Fred. So we'll move to the end of this and see the overall result. Here we are back again at the end of as we're drawing close to the end of the series. So it's a classic trend following model. We can see periods of outlier performance where we get this dramatic increase in our equity curve. We get periods of stagnation and drawdown, which is common with all of our trend following models. Here's a nasty drawdown here, but then we have these nice lift ups in the equity curve. So this is a classic single market trend following system using a Donchian breakout applied to real market data. We'll just quickly have a look at the report. In this, we were running this over a 20-year period. We had 474 trades, profit factor of 1.54, and a maximum drawdown of 4.14%.
Yeah, so it's not flash, but it proves that the Donchian trader has been able to grab some return from that particular instrument.
Excellent. Okay, Fred, so from here now we want to use this same model on the random market data.
So what we want to show now is if we just open up a blank chart there, Rich, and we're going to drag on our random walk.
Yeah, actually we might show them where this file is saved.
Well, let's show them how they're created first, just to run through a couple
of
yes.
random. Okay, so I'll put up a chart here. Here's our daily chart. Now what I'm going to do is I'm just going to close the strategy tester and go to my randomizer, the random walk.
Yeah, so what we're going to do first, Rich, we're going to run the random walk script that we created and have showed people how to use, and we're going to just load it up without any bias just to see what sort of graphs we get. So
Sure, Fred. I'll set that up now, turning all of those biased settings to false,
Yep.
and we'll generate a random series. So let's go. Done.
Okay, so there we see a random series. Oops, where do we go?
There we go.
The market data in white, the random series in red and green, and look at previous video to show how that's generated.
Yep. Okay, so
So now what we're going to do, Rich, is we want to run that again, but this time we'll put some bias sections in there and create a series of random a random chart with bias. So let's do that again.
all right, Fred, we're ready to go. Let's run it.
Okay, so now it's done, and again you can see where we've added the bias.
Bias here. Bias here.
Before you leave that screen though, right in the middle here, you'll see even the random chart does show impulse moves. So interesting to note that random charts do look like real charts.
They certainly do. To the life of me, I find it impossible to distinguish visually between the two, but there might be better people than me.
So now we've got some random data. What we didn't show you on our last video is that there's, as well as creating these charts, we actually create a couple of files. Do you want to grab them, Rich, and just bring them across?
Sure.
So what happens is the price data has been captured in a couple of files showing purely random, and then the same stream with bias. So if we open one of them up,
I'll open up the random.
and here you can see a data stream which can be imported back into MT4. As again, Richard's shown you how to do this before. But we can now see, or we can simulate a strategy test using that same equity curve that we've just demonstrated online there. So let's grab that, Rich, and have a play with that.
Okay, so now we're going to use that trend following model and apply it to that market data.
So let's have a look at the purely random one first.
Okay, so what I want to do here is...
So we open up the History Center and we import that random data series.
So in this case we've labelled it R1, this one here.
Purely random, yep.
So we're going to load that. I think that should do it.
Okay, and what you see here is an anomaly, if you like. We've added the random data over the top of the real market data, but because we've got a live account running here, it's MT4 is updating the current price. So you can see here that that huge uplift is in fact our comparison between our random data series and what actually the price of the Aussie is right now.
Yes, because that's the current price that Pepperstone's recording, and this is where the random series ended. So I see this is because of this random walk variation we've got in the data between our real market data. Like it, Fred? Yep.
Yep. So now when we run our strategy tester, we've got to make sure we don't run into that last bar.
Okay. So I'm just going to get my strategy test. So our strategy tester will work off this data, but what we do is we just need to eliminate the last day from our random test here.
Yep. So let's run that and see what we get.
Okay, so I'll just put this on slow, and we'll see what equity curve we generated. It's on visualization.
Yeah, let's go.
So starting off now. Okay, starting to take trades. So this is this is off the random
The
market.
same EA we used previously, running off purely random generated market data. So there are periods where we're going to make money. And
It's doing quite nicely at the moment.
Let's speed it up
a bit.
slightly, yeah. Just to show you that it does trade and it does take positions as we get breakouts.
That's correct. Looks good so far, but as in our last YouTube episode on randomization, we realized that it typically falls over after a certain number of trades generally, doesn't it? You know, as you increase your sample size, there's a deterioration in the equity curve on your random data. It'll be interesting to see if it applies here.
I think what that really demonstrates is that the extent of the outliers isn't as great, and so we're getting caught with frictional costs and many false breakouts effectively.
Yeah. Well, at the moment though, we've had almost 124 trades at the moment. It certainly held up well, but now we're starting to see a deterioration. So we've got to about 100 trades here in this example, and it looks as though it's starting to deteriorate, but we'll see how it plays out.
What's interesting though is when you watch this, it trades just like real market data, doesn't it? There's nothing strange about it. The only difference between this and the previous run was that we are looking at purely random price bars.
I'll speed things up a bit, Fred, and we'll get to the end of this. Certainly not as powerful as the real market data, is it?
Well, I think what we're trying to show here is that the real market data does have a bias in it, but with this market we're looking at here is totally unbiased.
So our trend following models are still working according to their rules, but on this random market data they're having a hard time extracting a definitive edge from this market data.
Well, that's because we haven't given it an edge yet, and that's what we have to show in our next run.
Excellent. All right, so that's it. So this is a sad story if we look at the report here. 561 trades, a few more trades taken,
number,
maybe a few more. We've got a much higher drawdown, double the prior drawdown, 8.45%, a negative profit factor here. So
not real great.
Not real great. Okay, Fred, where do we go to from here?
Well, now we're going to do exactly the same thing again, but this time we're going to bring in the biased random data.
All right, so I'll just load up the biased random market data by importing it over this data. So biased data is the B1 series here. I'm just going to open that up and select it.
Let's just check that graph, make sure it looks reasonable.
We've still got the lift because even with the biased data there's a difference between the current market price of Pepperstone and where it ends. So we'll use this data then.
Let's go.
With our model. Everything's set up already.
Just slow that down a little bit.
Here we go, Fred, so off we go again. Now, because we've inserted these 5 sections of bias in the random market data series, it'll be interesting to see the impact of that bias in the series on our trend following models. And this bias is quantitatively referred to as a term called serial correlation, where a particular area of a time series is codependent. In other words, one price point might be dependent to another price point. So there's a relationship of causality in that the individual bars of a price series, unlike a random series where each of the bars are independent to each other.
Well, they're not really independent. They still rely on the same start and end point.
That's correct. They are bound by the start and end point, but their degree of variation varies randomly within that context.
And there's no inherent bias in a random market, whereas here we've implied a bias.
Yes. So things are starting off like it did with that random model. I'll speed things up a bit. But what we want to see to prove our point is that this significantly accelerates beyond the result of the random series, and we can visually see these outlier periods of correlation in our equity curve.
Now we've been testing this, pardon me, on a trending system, but it'd be interesting for those so inclined to look at mean reversion and see how that might perform.
And pattern recognition, etc.
Which we're not going to get into, but for those who wish to try.
Gosh, I hope this is actually good. So there's that looks like a big step up of an outlier. At the moment it's hard to distinguish between the randoms. Oh, here we go. So this is a massive outlier here where we had bias in the series, and we got these magnificent trending periods with multiple systems. The equity curve now has just shot up.
Now, what Rich was originally worried about was that this looked like the random series, but if you recall, we are actually embedding this bias on that same random series. So in those periods where there is no bias, it will perform like the random series.
Exactly, Fred. It's quite phenomenal, isn't it? And this is a very similar result to what we see in the real market data. We get these periods where it's very hard to define our performance. We get positive, favourable and unfavourable performance, but there's no real bias in that performance, which could be attributed just to random price.
Yep.
But then where we get, when we hit our outliers, and that's what our whole game is about in this trend following space, it's hunting these outliers. You can see that once we get these areas of serial correlation or bias in the series, our models take off. And here we've got an example where we've deliberately placed this serial correlation in the series, and look at that fantastic equity curve. That just really
proves it. What's the report
it.
look like on this one?
Profit factor 3.39. Obviously we've put a bit too much bias in the series here, Fred, but it certainly demonstrates a point, doesn't it?
It'd be nice to be able to dial that in as in the real market.
It would be. I wish we could construct our own real market data. 4.31% drawdown, 534 trades, about similar as the last run we did on the random series, but a totally different result, just by inserting those 5 periods of serial
bias.
correlation or bias in the series.
So for me, this really demonstrates that it's all about the market data and the bias in that data and the ability of an EA to extract that.
Yes, and what you've given us, Fred, is a tool that we can use to really stress test our models, where we're not dealing with the vagaries of real market data, which we can't define where the random or serial correlated components are of that series, and we can create them ourselves to then rigorously test our models. And a mean reverter could do the same with their models, as could any other form of algorithmic trader using this particular script you've developed. So well done, mate.
Good. All right, mate. Well, let's call it quits there and catch everyone later.
Okay, thanks everyone. Bye-bye.